Welcome to the channel. My name is Kyler Johnson. Every single week I put out a video covering a specific company in the stock market, news that's going on, or really just anything that I find important. And this week we are going over Nvidia, which has absolutely dominated market news for quite a while now. Nvidia has contributed a ton to the S&P 500 gains so far this year. Companies continue to raise their price targets on the stock, and just so much good news coming out again and again for this company. People can just not get enough of it, and for good reason, as it goes to higher and higher peaks, and briefly this week became the most valuable stock in the world. To look at what Nvidia has done, let's take a long-term view of its stock chart. You guys can see IPOing in 1999 has returned over 300,000%. Looking at a shorter period of time over the last 3 years has returned over 6x. And even just in the past year is up right around 200%. And it is obvious why this has captured everyone's attention. So let's get down to the real question. Is Nvidia overvalued? Let's take a look at what's going on here and where they sit. And I will say it probably is well deserved that Nvidia is in the news so often. They account for 40% of the NASDAQ gains so far this year, with the other 3,431 making up the other 60%. You guys can see that in this chart right here. Nvidia just has absolutely thrown the market on its shoulders and taken it higher and higher so far this year, which has just been incredible to see. When we're looking at Nvidia specifically, the biggest driver of growth they had was their data center revenue, which has grown at an average of 75% per year for the last 5 years. And you can see this chart that I pulled from their most recent earnings. These are the 5 years that they're looking at having some really solid growth and then absolutely exploding in 2024. And they are seeing continued growth, although it is slowing as far as its percentage gain. They are still seeing growth there. So it's no wonder why this company has captured market headlines and is constantly in conversation. So a good question right now is, are you too late, or is Nvidia still a great investment? First, let's get a general idea of what their growth could look like going forward. And I decided to break this down by looking at the current industries that they're in and the forecasts that many analysts have given them. Regarding the supply of data center GPUs, they're expected this to grow about 30% per year. Gaming and PC AI about 8.7% per year. Personal visualization about 11.6% per year. And automotive and robotics a little over 11% per year. And this is the average of 5 different analyst growths that I was able to find. You can see that they're expected to grow very well over the next 5 years or so. And if they grow their fiscal 24 revenues by the amounts that I've shown above here, this means that they'll pull in revenue of about $182 billion in fiscal year 2029. And if they retain their current net margin of 48.85%, this means that they will generate an incredible $88.9 billion in cash. And that is incredible for any company that you're talking about, pulling in almost $90 billion per year in profit. So when you look at the story of this company and its potential, it honestly feels like a no-brainer. And I think that's what a lot of people are seeing right now, is they have an absolutely phenomenal story of their past and an incredibly bright future looking forward. But when you do this, it's really important to pay attention to what price are you paying for the privilege to be a part of that company's future, to own a piece of that bright future. Just like you would jump at the chance to buy an iPhone at $10, you probably would never take someone up on the offer to buy one at $100,000. So price is important, and certainly you can pay too much for a good thing. But what is a good price? Below is a chart with an average historical price to earnings ratio of the S&P 500, and that average during the 150-year period is 16. That's the average price to earnings ratio. When referring to a high quality company like Nvidia, It can certainly be appropriate to pay a far higher price than that, though. Anytime you're looking at a company that's dominating its industry and has very good potential growth, it's worth paying up a little bit more. So I decided to compare Nvidia to some of the other highest quality and largest companies in tech like Apple, Google, and Microsoft. And these companies over the past 24 years have averaged a price to earnings ratio of about 23.5 times. Given that, Nvidia is probably growing faster than these companies, and I'm going to bump that up to about 28 times. I think Nvidia, just being in the industries that it is, it's got a little more road ahead of it in growth, I think, and so I decided that it was appropriate to just give it a little bit more now. So let's break this down. If Nvidia grows with the industries they are in to make a good profit of about 90 billion in 2029 and gets a very good multiple of 28 times, which again is higher than the average multiple for Apple, Google, and Microsoft, they will have a market cap of about 2.52 trillion. And that sounds pretty good, right? Well, not really, when you realize Nvidia currently has a market cap of over 3.1 trillion and actually hit above 3.3, around 3.4 earlier this week when it became the most valuable company in the world. This would mean if you bought this company and it almost tripled its earnings in the next 5 years and at the end was valued at a higher multiple than Apple, Google, and Microsoft have historically been, you would lose money. Let's say I'm totally wrong here though, and Nvidia will continue to prove it can grow faster than its industries, and its earnings will actually be up to 110 billion, about 22% higher than I estimated. This means that they would have a market cap of about 3.08 trillion at 28 times earnings, which is better, but does still mean a loss after 5 years. That's not a great picture. So what would it take to get that 10% per year return just based on numbers? If we take a look at this discounted free cash flow that I put together, you guys can see here what it took to get this 10% cumulative average growth rate. Nvidia would need to grow at about 44.14% per year for the next 5 years, and it would need to get to that 28 times price free cash flow. And then if it does that, you will get an average return. Could Nvidia grow at 44% per year? It is possible, but it's important to understand what you have to assume for this to come true. First, you have to assume no competitor will threaten their market share in the next 5 years. Then second, you have to assume their net margins will remain around 49%. Lastly, you have to assume Nvidia will grow far faster than industry forecasts by a fairly wide margin. Keep in mind, they already have 98% market share in GPUs for data centers, which is their largest driver of growth. If all of that comes true, in 5 years, the stock does that growth and sits at 28 times multiple, you will have only done the market average. To me, those are some pretty big assumptions. And in my opinion, one that I just can't feel comfortable making. Could I be wrong here? For sure. Will Nvidia go higher? Probably. But this is not a company that I would feel comfortable buying at these prices. Most likely, over the coming years, other companies like AMD and Intel will challenge Nvidia more directly, potentially taking some of their market share, but almost certainly forcing Nvidia's sky-high margins back down to earth. If you guys follow the semiconductor world, you'll know that Intel has essentially been plucked out of everyone, and the government has become the government's chosen one, for lack of a better way to say it. If I remember correctly, the government has given Nvidia a little less than $50 billion between grants and subsidized loans to be able to build out and be a competitor to Taiwan Semiconductors, but this is also going to allow them to generate more cash to be competitive in other areas as well. And they're already doing this regardless of the cash that they have. In fact, they just released a chip, I forget the name of it, but they claim that it is 50% faster than Nvidia's Hallmark chip and 40% more efficient. It's going to be interesting how things shake out over the next coming years, but in an incredibly quickly changing industry, those are some very, very hard assumptions to make. And just like Tesla has shown us, no company, no matter how bright their prospects, can go up forever. And I expect no different from Nvidia. Another point as well, you must always compare an investment that you want to make to the best current option that you have. Below is a fairly conservative discounted free cash flow model for Alibaba, which is not necessarily the best investment I have, but it was the most simple to use as an example. If they grow at just 8%, which is slightly below their 5-year average, and at an 18 times free cash flow multiple, which is again below their 5-year average, and buy back 1.5% of shares per year, which is half of what they plan on doing, then you will return more than 26% per year, more than 2.5 times what you would get from making those really, really optimistic assumptions from Nvidia. You guys can see how that kind of works out here. It's actually a 26.71% cumulative average growth rate. Charlie Munger says, people calculate too much and think too little. And I have to say, I agree with that here. If you sit down for too long doing calculations, you can justify almost any stock. And I say that after showing you guys a whole bunch of calculations, but when it comes down to it, it's important to just take a step back, use your common sense, and think about, can a company grow this quickly in perpetuity? It's kind of hard to swallow. So really step back and think about how businesses operate and really reframe your purchase of any company as just that. You are purchasing ownership in a company, and just think through it without actually crunching any numbers. And that can be really great to give yourself perspective on if this is something you would be comfortable doing. And after doing all that, you might come to a different conclusion than me. But to me, I think it's plainly obvious that Nvidia is in a rapidly changing industry that is hard to predict even just a year or two out. So be careful what estimations you make here. I spent a lot of time deciding how to share this information with you guys. I hope this was valuable in understanding where I think Nvidia sits here. From here, we're going to move on to answering questions from last week's video and sharing some news on my current portfolio, news that I thought was valuable. So if you guys were here just for the Nvidia portion, it was great to have you, and we will see you in the next one. If not, let's stick around, and we're going to move on to the next piece. First, we're going to go into answering questions. Hopefully you guys like this a little bit different than I've done it in the past. First, had this comment. My last video was touching on Alibaba and its potential in the cloud. And you can see here, I apologize, I don't know how to pronounce your username, but just a lot of fears about things going on in Taiwan, recessions, risks investing in China, cutting cloud prices, losing market share, and just all the bad things that I think most people think about when they're investing in any company in China. I'll touch on each of these points. China, for sure, carries more risks than investing inside the United States. That is very plain and clear. And that's why it's important to do a lot of work to understand what company you're investing in. And as many other people that I follow that talk about China have said, it's important when you're making a purchase in any Chinese company that you know that you're getting something high quality. And when you're purchasing a really small cap stock, it's hard to know that. And that's why I've chosen Alibaba. I've looked at many others, but kind of come to the conclusion I don't have 100% confidence that the numbers they're showing me are real. Not only that, they're positioned fantastically, as I've mentioned in many other videos. It's important to understand that context for all this. There is risk, but there's a reason why I picked Alibaba out of everyone here. I mentioned that other nations will allow Alibaba Cloud for their companies. It's important to essentially kick the US out of this conversation entirely. Alibaba isn't going to be taking market share from Microsoft, from Amazon, from Google, all these companies. They're going to be focusing on China and Southeast Asia, where they are the largest player. And that's where they're going to get their market share. It's already happening. They already have great market share. And if you guys are wondering and wanting more details on that, go watch my previous video. I touched on that more in detail. Things going around Taiwan, there's always going to be some geopolitical risk. There's always going to be a reason to not invest. Even if something were to happen, people are going to continue to buy things. People are going to continue to integrate technology into their life. Will it be a bump in the road? For sure. Not saying that it couldn't happen, but I don't think it's as big of a risk as it sounds as well. As far as a recession, again, Alibaba does very, very, very little business in the US. So if there's a recession here and it goes down, works for me because it's almost going to affect them. Not at all. We'll see though. Already mentioned some of the risks. I would say that they are overblown. We're going to touch on some news actually about China and their economy here in a little bit, and things are looking very good there. Things are turning around pretty quickly. It's really exciting. Cutting cloud prices, I went into detail on this on my last video. This is actually a good thing because they're locking people into their ecosystem. Losing market share to PDD, it's important to understand Alibaba and PDD fundamentally operate in slightly different parts of the retail market. PDD operates in the cheap, really low quality, crappy product side, and Alibaba is more of the high end, great quality things. Do they have a little bit of overlap? Sure, but not much. And to me, PDD can take all the crappy low margin business that gets bad reviews all day long. I don't really care about that because Alibaba is the one that people go to, and they trust to get high quality items. So I'm not worried about this at all. The reason that they were raising money was actually to buy back more shares. They're incredibly cheap and they recognize it. They're basically saying, we've got a lot of money, but the way everything's all tied up between banks in China, offshore, being able to purchase stocks on the US market, there's just a lot of restrictions and stuff there. So if they were able to raise money, they could purchase back more quickly. And so this was actually very good news that they were raising money. It's also important to know that when you see a company that is growing, has fantastic market share, is generating a crap ton of cash, and it is beaten down because of all this terrible news, ignore all that news, strip it all away, and just look at the company. And remember, guys, I'm saying all this, but remember, this is just my opinion. Don't ever buy a stock just because some random person on the internet is saying so. Do your own work and research here. This is just my thoughts. When pessimism is so low that you can buy a high-quality company at low prices, in my opinion, that is just the time to do so. And it's going to be the time that everyone thinks you are an idiot. They're going to think it's the incorrect move, but just because a company is down and everyone thinks it's a terrible play does not automatically mean it's a good purchase. It has to be a fundamentally sound business. Alibaba has billions of cash on their balance sheet. They're not going bankrupt anytime whatsoever. They're the largest cloud provider in the country. They're the largest retailer in the country. They have tons of other outs. They own pieces of tons of other businesses. They have so many outs. So hopefully that clears things up a little bit. And again, do your own work here. You've got to do the work and then you can have confidence. On to the next question by Pedro, where he asked me to check out Melly. And I have actually looked at this company in the past and I actually passed on it at under $1,000 a share. It was back here right around this time. I think it was just before this move up here. I think it was under $900. It was one that I seriously considered. I seriously considered it, but at the time, I didn't feel like it was quite far enough down for me to justify making that purchase. And so I decided to pass on it. It's certainly one that I'm looking at. I think it's a high quality company that's growing very well and could very well be a great buy. If I had to guess, it will probably work out. One of the most important metrics, free cash flow, you can see has absolutely taken off in the last year and a half or so, sitting at about 5.23 billion. Price to free cash flow, currently they sit at about 14 and a half times, which is very good. Don't get me wrong, but they just didn't quite fit what I wanted. They're a very good company, I think. I think they have a very good future, But for me, it was a pass. In your comment as well, you mentioned they're getting into the payments business. I would do a lot more research there, and it's important to understand how complex and competitive the payments industry is in South America and Mexico. It is incredibly competitive. So I don't know how optimistic I would be on that front. But overall, it's a great company. So overall, like I said, it's a solid company. For me, it's a pass. It's just not down far enough. Even though they're generating a crap ton of cash and probably have a pretty bright future. We'll see. We'll see what happens here. It's one that I definitely will watch. Moving on to the news and things that I wanted to share with you guys. Some important piece, not necessarily of news, but that was relevant to last video and really just a conversation around China in general, is looking at their demographics. And it's important to know that the prime spending age for people is generally between the ages of 30, 35 to 40, 45. And so when you've got a country that's got the bulk of their population in those age groups, usually that's a very good time because companies are going to be growing their revenue, profits are growing. It's just a booming period overall for the economy. And you can see right now, this is China's population pyramid, and they've got a big group of people coming through. They're 35 to 39 and 30 to 34, entering those prime spending years where they're having families, getting settled in their careers, moving out, purchasing a home, purchasing another vehicle, purchasing a fridge, couch, all those things that drive an economy. So that's one of the big overarching reasons why I like China right now. Some other quick news that I wanted to share with you guys. This was from Bloomberg, where they said the China solar industry in a deep down cycle, says polysilicon maker Amy Song says many China solar manufacturers are under a serious downturn. She says layoffs by small players look permanent. And I gotta tell you guys, I am just like licking my chops at this. This means a fantastic future for Dokao, ticker symbol DQ, which is a polysilicon manufacturer in China, which is kind of the base building blocks for solar panels. And they have a ton of cash sitting on the sidelines to weather this downturn. And so essentially, go watch that video about Dokao for more details. It's an extremely cyclical industry, and the more companies exit as things get bad, the better it looks for Dokao, in my opinion. So excited for that. Some more news for China. They had some economic data come out recently, and their retail sales beat expectations, but industrial output and fixed asset investment missed. Let's look at some of the numbers very quickly. The retail sales climbed 3.7% and beat expectations of only a 3% rise, which is absolutely blowing it out of the water, in my opinion. Lets you know people are spending, and that is great news for companies, especially Alibaba, which is a massive retailer. Industrial output grew 5.6%, missing the 6% increase. In the US, if we had 5.6% year-on-year increases, that would be incredibly celebrated. But in China, that's not cutting it. So important to have context. China is still growing here. Their fixed asset investment rose 4%, just shy of the 4.2% forecast. Certainly hope to see it continue to improve, but just wanted to share this with you guys. Some other news as well. China unveils policy package to shore up star market. Regulators to prioritize certain listings and support mergers, and Chinese officials are trying to boost their markets and economy. Again, even with all the pessimism things going on, it certainly is justified with fears around their housing market and industry and just all the pessimism. But the country is now just throwing money and repealing restrictions to resolve any issues going on. I'm very excited for China's future over these next few years and position myself to benefit. Last piece of news, GXO advances humanoid strategy and announces multi-phase R&D initiative with Apptronic. GXO just seems to consistently be at the forefront of logistics and excited to be a part of their future. They're the world's largest pure play contract logistics provider. And they're figuring out ways to continue to be right at the front of their industry, to be able to provide more value. Their bread and butter, it's just purchasing smaller competitors, integrating them, and really bringing those synergies together to cut costs, grow revenue, continue to bring in more cash, and I just love to see it. So excited to be a part of this company's future here. Hopefully, with everything you guys have heard today, it was useful, it was valuable. If you have any questions, throw them down in the comments below. I will be happy to answer them in my next video coming up. Let me know what you guys think, if this was a good format, only a little bit of changes. But again, thank you guys for being here, and we will see you in the next one.